Hey, Bowtie Nation. Joseph Hogue here with your weekly stock market update. And before we get into the stocks, the headlines, and what I'm buying right now, I need you to hear this clearly. If you reinvesting in 2026, the same way you've been investing for the last 2 years, you are setting yourself up to lose money. Not because stocks are suddenly bad, not because investing doesn't work, but because the backdrop is changing fast and markets punish investors who refuse to adapt. We've had incredible returns recently, almost unusually strong gains, but the conditions that created those returns are fading. Midterm elections, a Federal Reserve pivot, and a fragile labor market are all lining up to make 2026 one of the most important investing years of this entire cycle. And today, I'm going to walk you through my exact 2026 investing playbook, the 3 major catalysts that could drive or derail stocks, how I'm thinking about risk versus reward, and the 7 stocks I'm buying right now to position for what's coming next. Stick around because I'll also update you on Amazon, Broadcom, and my overall stock market outlook. And trust me, this is not a year you want to sleepwalk through as an investor. Now, even after the sell-off we've seen since November, stocks are still up roughly 16% this year. That's a great return by almost any historical standard. But here's the danger. Strong markets breed complacency. And complacency is exactly what hurts investors when conditions shift. Between the midterm elections, signs of a slowing jobs market, and the Fed's next move, 2026 could look wildly different from what investors have gotten used to. And even if you're a long-term buy-and-hold investor like I am, it absolutely pays to understand what's coming and how it could impact markets along the way. That's why I want to lay out a clear, flexible 2026 playbook. Not predictions, not fear-mongering, but a framework for thinking clearly when volatility returns. What really struck me as I looked at the market recently is how similar this year feels to 2018. Stocks performed well for most of the year back then. Investors felt confident, and then came a sharp sell-off in the final months. That sell-off was much worse in 2018 than what we've seen so far. And honestly, it could still get worse this time around. But here's the key lesson most people miss. If you stayed invested through that volatility, you made a lot of money. Markets recovered. They always have. So maybe the most important takeaway, isn't trying to dodge every pullback. It's building the confidence to hold great investments through uncertainty. One of the biggest influences on stocks in 2026 will be the midterm elections. History doesn't repeat perfectly, but it often rhymes, and the data here is hard to ignore. Going back to 1931, midterm years have behaved very differently from other market years. Stocks tend to stagnate for most of the year, moving sideways as uncertainty builds, then rally sharply once the election is over and that uncertainty clears. Markets hate not knowing what comes next, and midterms create exactly that kind of fog. Investors hesitate, volatility rises, and prices swing wildly as narratives change week to week. In fact, midterm years tend to be more volatile than average. The standard deviation of returns is around 16% compared to about 13% in non-midterm years. And that volatility usually peaks between June and October, right as election rhetoric ramps up. Candidates focus on economic pain points, promise sweeping changes, and markets react to every headline. So if you're expecting a smooth, steady climb higher early in 2026, history suggests you may be disappointed. This could be a year where markets churn, spike, drop, and frustrate investors who are impatient. Now here's the interesting part. While midterm years themselves can be choppy, the year after midterms has historically been very strong. Since 1950, stocks have returned about 15% on average in the year following midterms, compared to just 7% in other years. Often, the party in the White House loses seats, leading to political gridlock, and markets actually like gridlock because it limits drastic policy changes. But this is where I want to be very clear. You cannot build an entire investing strategy on averages alone. 2018 was also a midterm year, and it broke the mold. Stocks sold off hard, then rebounded, then sold off again, then surged into year-end. So elections are just one piece of a much larger puzzle. Another massive piece of that puzzle is the Federal Reserve. In 2026, the president will appoint a new Fed chair to replace Jerome Powell. Whoever that is, it's likely to be someone more open to lower rates. The biggest wild card next year, though, is the labor market and consumer spending. Jobs data has weakened significantly since February, with some months showing job losses and others barely keeping pace with population growth. Unemployment has risen to about 4.6% from last year's lows, and while that's not catastrophic, it's a clear trend investors can't ignore. So far, consumer spending has held up, with retail sales growing around 4% annually. But consumer confidence surveys tell a different story. People are increasingly pessimistic, worried about job security, and that disconnect is important. If job weakness finally spills into spending, it will ripple through the entire economy. Now remember, stocks are not the economy, but recessions aren't friendly to market sentiment, especially when layered on top of political uncertainty and tightening financial conditions. That's the risk side of the equation. On the opportunity side, though, we're seeing something incredibly powerful: AI-driven productivity and investment spending. Despite the weakening labor market, GDP growth has been strong, largely fueled by hundreds of billions of dollars being poured into AI infrastructure. If this mirrors the internet build-out of the late 1990s, that investment could support economic growth for years. Even more important, AI is starting to drive real productivity gains. Economists estimate AI could boost productivity by 0.5% to more than 1% annually. That may sound small, but on a $30 trillion economy, a 1% boost is like injecting a $300 billion stimulus every single year. That's massive. So while there may be short-term trading opportunities, hedging, holding cash for dips, managing volatility, my focus remains on long-term themes that can compound wealth regardless of short-term noise. The first of those themes is AI. It's obvious, but still powerful. AI stocks have pulled back recently, underperforming the broader market, but investment spending is expected to exceed $400 billion in 2026. Business demand isn't slowing. That's why I'm still buying quality names on weakness. Amazon is a great example, down from its highs, but still dominant in e-commerce, cloud computing, and advertising. Broadcom has fallen nearly 20% recently, but it touches nearly every part of the AI data center ecosystem and continues to post strong revenue growth. And Supermicro Computer, despite being down nearly 50% from its highs, remains a leader in AI infrastructure and trades at valuation levels that imply massive upside if growth continues. My favorite growth theme for 2026, though, is tokenization and stablecoins. This ISNT about being a crypto speculator. It asks about recognizing an unstoppable shift in finance. Major institutions like JP Morgan and BlackRock are embracing tokenization, with trillions of dollars in assets potentially moving onto blockchain rails. And about 70% of that activity runs through Ethereum. As tokenized assets grow, transaction volumes grow, and that supports the entire ecosystem. That's why I'm investing through Ethereum-focused ETFs and diversified blockchain funds. Another theme I love is cybersecurity. Cyber attacks are exploding, costs are massive, and this is one area of IT spending that simply cannot be cut. Companies like CrowdStrike and Palo Alto Networks are positioned perfectly for this trend, and recent pullbacks have created opportunities. Beyond these long-term themes, I'm also watching names like Bloom Energy, which could solve one of AI's biggest bottlenecks, power generation, and Rivian, which is starting to look like a real contender with improving fundamentals and strategic partnerships. Wrapping this all together, 2026 is shaping up to be a pivotal year. After a powerful bull market run, we should expect more frequent pullbacks, more volatility, and more uncertainty. But uncertainty creates opportunity for investors who are prepared. I'll be right here breaking it all down with you every step of the way. So make sure you're subscribed, stay disciplined, and remember, the goal isn't to predict the market perfectly. It's to position yourself so you can win no matter what it does.